Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look through Twitter, see what's going on, what people are talking about. Uh, Obviously, I'm going to interject my opinions, financial opinions, mostly related to commodities and or financial topics. So let's dive in here. Let's take a look and see what's going on Twitter. And again, at finding_finance if you want to follow me, and finding-value.com if you would like to sign up and join the membership. And we've got platinum question and answer session coming up. The next one's going to be at 5 p.m. Sunday, Mountain Standard Time. So we've got Cuppy here. He's got an oil thread. Might as well go over the oil threads because, well, I like oil. So it says in April, we were drawing roughly 2 million plus barrels per day, with an expected expansion to roughly 4 million barrels per day as OPEC plus cuts begin in May. The question was, why was oil trading so sloppy? Strategic Petroleum Reserve was selling a few 100,000 barrels a day, but that wasn't enough to move the needle. A lot of the oil traders frantically asked each other, what the hell is going on? What are we missing? We looked under every rock and we found a few wrinkles, but not enough to smash the price. Effectively, the only bear thesis was recession, bro. Then we started looking at the speculative positioning. Over a 3-week period, specs flooded the market with 10 million barrels per day of paper supply. It was one of the most rapid net position liquidations ever. With a massive buildup of spec shorts, suddenly we had our answer. The market was overwhelmed by the supply of paper barrels. And that's what I talk about when I say financial supply and demand of oil versus the physical demand and supply of oil. Maybe the recession bros get it right, but if it doesn't come soon, they're going to be in a world of trouble. Speculative length is unusually low. It's the 6th percentile and into one of the most telegraphed deficits in history. Meanwhile, production's rolling over at $70 a barrel and will miss. For every spec short, a commercial goes long. Would you rather drill wells with $80 break-evens, using actual EURs instead of Ponzi math, or buy oil at $70 or less on the strip? I've been early here, but look at what we've wadded through in terms of balances. China shut down, Russia purged inventory, SPRs dumped, winter was warm, Iran liquidated the floating cash, and now specs sold 250 million barrels of paper. Meanwhile, oil mostly took it like a champ. I don't know when it turns, but when it does, it will be explosive. Everyone gave up hope, yet the fundamentals keep getting better. I feel like I'm the last and loneliest oil long. I like it that way. So that's what Cuppy thinks about the oil markets. I agree. It's a battle between the physical market and the financial paper market. Eventually, I think the physical market will win out, and it will win in a way that could be very explosive. Why would it be explosive? Because the deficits will be so large that it's just going to pummel through the inventory. That's why. Coming up, so North Star says, please take a moment to understand what this chart is telling us. It's critical for your investments in coming years. Again, this is a big, long-term trend. What he did is he took the DXY and divided it by the producer price index. In this gigantic downward movement, that's where your commodity bull markets occur. So we had a big bull market in the 70s all the way down to the bottom of 1980. We came back up in the 80s, early 80s, and then we came back down in the mid to late 80s, all the way back down to 1995. We had another area where we came back up, broke back down mountain, baby. 2002. In 2002, that's where commodities really took off. Commodities did crazy stuff in the 70s, crazy stuff here. And the reason they did crazy stuff is the commodity to stock ratio. Money was floating flowing differently than before. We have a big breakout that occurred in 2020. We came back down. We came back up to do a retest in 2023. That's what we're doing now. And then it looks like to me that we're going to continue lower in the future, where the DXY is going to underperform the producer price index. He says the next little rally for DXY should fail at the 4-year MA and sleep mode line. So we might come back up a little bit more before heading lower. So that's the market conditions that we are in. So here's Shabam. He says Saudi crude export trend from Vortexa points to them walking the walk thus far. This is cargo volume. You can see the cargo volume starting to really come down. And then you've got that delay before it hits America, and we'll see it in our inventory numbers. It's coming, and it'll hit in June. Come on down. So we've got national home sales volume rebounding. Wait, whoa. I thought we were in a housing bubble, guys. Shouldn't sales volume be declining? Why is the volume rebounding here? What is going on? Maybe that seasonality is kicking in. Now, I don't know where this is necessarily going to go. All I can tell you is the demographic is there that wants to buy homes. And it's a pressure that will continually be applied to the upside. Affordability can slow it down. I don't think it can stop it. That's what I'll say. It can definitely slow it down, though. Here's U.S. oil and gas drilling activity. It's slowing sharply in response to the fall in prices since mid-2022. So the total number of active rigs fell by 17 over the 7 days ending on May 12th, with a particularly large decline in rigs targeting primarily gas-rich formations. We also saw natural gas go up a little bit here just recently. But this is the number of rigs drilling for oil and gas in the United States. And you can see it, we are declining. So I would expect that to head lower if prices continue to be low. Charlie, he's got lumber futures. So he says lumber futures at the lowest level since May of 2020, down 81% from the peak in May 2021. The one thing I want to say here is this big move over here is not solely from demand. It's not a demand-driven event with supply being stable. This right-hand side had a combination of demand killing it and supply going in the opposite direction, which caused this gigantic move in pricing. But that pricing move is very, I'll say, overextended. And obviously it was going to come back to a level that is more sustainable, where demand and supply are more sustainable to each other. So I don't think that this going up and this coming back down necessarily is a good indicator of the economy and all that stuff. I think it's an indicator where it's kind of like you're driving a car, all right? If someone had to answer the question, is your cooling system sustainable? And what they're trying to answer is, if you're running the car and it's moving, and you've got ducting that you put in for your radiator and your oil heat exchangers, you've got all this ducting that you created, and they looked at this chart here, and all they looked at was the chart, right? So let's say he was driving normal back here. He started racing the car. It came back up, and then he came back, slowed the car down. He was driving normal again here. So the red line is kind of like the average, and it's like, yeah, it heats up a little bit if you go racing and you push the engine really hard, engage the turbo and all that stuff. But it cools right back down if you relax. You're not pushing the car. Let's say he stopped the car, and this was the overall resultant of this car being stopped. Someone would say your cooling system is basically malfunctioning. They said this guy must have been racing out of control, and the car overheated and blew up. That's what they would look at the chart. And we talk to the person, they say, okay, what happened here? Oh, no. I stopped the car right here in 2020. I stopped it. Problem was the car started to overheat because the fans didn't kick on when the car was stopped. That's a totally different picture than the radiator and the heat exchangers not being able to reject the heat out of the car when it's moving and racing. Moving and racing, the economy is moving and the supply was uninterrupted. The demand is causing these movements to go up and down, the demand and supply. But if supply is stable, demand is the factor. On this side, it's a completely different ballgame. Supply is not stable, and neither was demand because they were manipulating the demand to be increased. They were doing QE to hold interest rates lower. So they basically tried to, launch lumber into the atmosphere because they held interest rates down during a time that people, a demographic, was looking into, buying homes. And then they stopped the supply of lumber. So of course this just rocketed higher. So now it's trying to find that equilibrium between supply and demand. I don't think it's a good indicator of the economy as it's trying to find that equilibrium point. It says housing May 15th, weekly update. Inventory increased 0.2% week over week. So this is not really that much inventory, guys. I mean, look at the inventory here. Altio's single family active inventory 7-day average. That's not high. It's super low. We've got 2 years that are below it, 2021 and 2022, and we're at a very low level. So I don't know what the housing crash bros are necessarily talking about. We have to see inventory increase for a crash from a supply-driven event. Right now, demand is eating up the supply that is out there. So maybe the markets are actually in equilibrium, and the pricing should be where it's at, given where the interest rates are at. That's one viewpoint. That's kind of where my head's at. But again, if they lower interest rates, this is going to drop back down. Inventories are going to get eaten up as people can afford more homes. So there's that. Here's one that's interesting. This is the natural gas power burn. He's got AR on there for Antero Resources, which is a good company. So what he's looking at is the natural gas power burn. So think of it as demand. This is demand for natural gas for burning for power. Look at how high we are, guys. 31, 31.2. This is very high demand from power burn. He says it's the shoulder floor is rising. So we're burning more natural gas, maybe because it's cheap. But we could work through our natural gas inventory levels maybe faster than what most people think. As natural gas becomes cheaper, we burn more of it. It's a cleaner solution than coal is. So obviously this is pretty obvious that we are burning a lot more natural gas than we did in previous years, especially in 14, 15, 16, 17, all that. I mean, just this demand keeps going up. I think we'll eat through it faster than what maybe some people think. It's possible. Depends how warm the summer is as well. This is URA. This is the bull flag and gap. So here's your gap. It will be filled. That's way up there. Here's your bull flag. Again, this is URA, the ETF. Global X Uranium ETF. There's your big bull flag that everyone's talking about and that we're waiting to break to the upside here, which could happen at any second. I do think that the timing is roughly the same as it was during the last bull markets. But keep in mind, guys, I think the timing is not driven by fundamentals. It's driven by the stimulus that was put into the system. And I think that the stimulus was a kickoff. I think this bull market is going to be longer and higher than what most people project. And why is that? The other bull markets of commodities that we've gone through have been credit driven. What's coming, and this bounce here is credit driven. It was driven by credit coming into the system, the home prices going up, credit being created, stimulus money being injected into the system. That's all contributing to it. What we've got now is a supply problem. And I don't know if we've ever seen a supply problem as large as we're going to see here. That goes for base metals, oil, natural gas, just everything. Uranium, especially. This is uranium here. So when we combine this, I think the money is going to rotate more so than what it has in the past, because we don't have supply side solutions, and anything that's credit derived. So if they do deficit spending, if money comes back into the system from the housing market, if they do more stimulus, whatever it is, that money is going to rotate and go towards the problems in the market. The problems in the market are going to be commodity problems, at least the way that I'm viewing it. That's where the shortages are at. This is Athabasca. Looks like we got more insider buying for Athabasca oil. Lots of people buying lots of money here. Interesting. We've got the entire world better get ready for gold and silver's fourth greatest bull era in 100 years. Expecting oil, uranium, copper, platinum to also do very well. So what are we looking at here? This is the SPX, the S&P 500, divided by the producer price index. And what we're looking for is a move sideways to lower. So that's these big consolidation periods that we're seeing. And we've broken the uptrend line here to the downside for this ratio. And we could see a sideways movement in this ratio of the S&P 500 in relationship to the producer price index. And this is where the big recession hits. And why does he say that? So the smaller recession in the front is generally caused by an increasing interest rate environment that flushes crap out of the system. That's the first one. And that's why I think that it's like 2000, 2001, 2002, that time frame, because that is where everything is aligning. That's where this is aligning. Once we get through this, we flush it out, we're going to get a big bull market in gold, oil, silver, all that stuff. That's wave 3. And then eventually, when wave 3 and wave 5 run their course, we're going to have a credit deleveraging event at the end. That's what the end of these big credit deleveraging events are. Here in the late 70s, here in 2008-9, and we'll get a big probably credit deleveraging event from the housing market in late 2020s, early 2030s, just like the thesis is basically that we have on the channel here. And the small recession, when everything kind of pulls back, I've said this before, I don't know how commodities will necessarily perform when we get that recession. Everyone and their mom thinks that we're going to get a recession. It is 100% probability, and that everything's going to crash. And it will be like 2008. I don't know if that's necessarily the case. Yes, everything could be impacted. We don't know how much. We don't know how big this pullback will be. If it's my guess, if the housing market remains resilient, we're not going to get as big of a recession as what most people think. Because jobs will be out there. People will be all right. They'll be making money. But there could be some things that need to get liquidated out of the system. Bankruptcies, companies, whatever it is. So here's another one. He says, some valid questions, thoughts on this. I'll give you my thoughts. Sure. The guy says, feeling discouraged. We're early 30s. We've got $150,000 combined base with $40,000 to $90,000 in bonuses a year. That's quite a bit of money, guys. They're killing it. Job stability isn't as secure as we'd like. Tech sales, interior design. Zero debt, $160,000 in cash, $250K in retirement mutual funds, $25K in an HSA. Currently renting a 2-bedroom, 2-bath for $2,500 a month. Both drive 10 to 15-year-old cars in good working condition. We want and honestly feel like we deserve a 4-bedroom, 2-bath, roughly that size square feet, with garage in a decent neighborhood so that we can lay down roots and start a family in a house we can grow into. I feel so discouraged having put offers on houses in 2012 and 2019, not getting them for one reason or another, only to find myself in what I've always thought would be an ideal financial situation, only to feel poor. Houses we want were 450 to 550K in 2019. Those houses are $750 to $900,000 now. I don't want a $5,500 a month mortgage. I don't want a $4,500 mortgage. I wouldn't be able to sleep at night being on the hook for that much every month for 30 years. Am I crazy? Do I need to reset my expectations? Are $5,500 a month mortgages really the new barrier of entry to an upper middle class life? That is all. And I think this guy is in Canada. He's in Canada, I think. But I mean, yeah, I think what's really difficult here, guys, and I saw this coming when, that's why I bought in, 2010s or whatever. I saw this coming. I saw the demographic coming, and I'm like, oh, I got to get in now. I got to get on it right now, which I did. It took me about 6 months to a year to find a house that I really liked, somewhere in that range, 6 months, 8 months, something like that. I did get outbid a few times. It was somewhat competitive, not like the late 2010s, early 2020s, nothing like that, but it was still very competitive. And I had this overwhelming urge that I had to get in immediately after looking at the demographic and how basically developing the thesis. And I said, I got to get in. I got in, bought a house. I put 20% down, and my payments weren't that bad. Then I refinanced some years later when it was really cheap in 2020, and that really pushed my payments way down, refinancing. So I've got really low payments for a 30-year fixed rate mortgage in America. My taxes are very low. I've got I just paid this past year. They were $2,500 or so. I live in a very cheap state for property taxes. It's like 0.5% or something. They did increase quite a bit for next year, but it's pretty cheap compared to everywhere else that I know. Insurance has actually gone up quite a bit. As weird as that is, home insurance and car insurance they've been on the up. That's for sure. And speaking about insurances, and if you guys, I drive old cars, all right, and I cannot justify buying and driving a newer vehicle. I can't do it. Why is that? In this state, my registration for my car is like 60 something dollars. All right, so it costs me $60 a year per car to register. I pay liability only insurance on all the cars we own. So they're older cars, they're not new, and I pay liability only for the car. What does that mean? Liability is just you're covering. Basically, you've got the minimum insurance required. They don't cover your car, but they'll cover the other person's car if you were to smack something up. So I pay for all the cars I own. I pay something on the lines of like $2,000 something a year for my wife and I who are on it, and 4 cars. And that's like 2,000 something bucks. So I'm paying 60 something dollars for registration. I'm paying very little for insurance because it's basically almost all of them are on liability only. I've got one car that isn't, and I don't drive it that often. And I start looking at this and they're like, oh, well, we're going to have electric vehicles. And I'm like, I'm not going to buy an electric vehicle, guys. The registration cost on a brand new car, and most of these cars are expensive now. You're talking $1,000 to register the car. Then it'll go down to like $800 the next year, $600 the year after, et cetera, et cetera, et cetera. I don't even spend that much in gas a year on my car. I mean, actually, you got me. I'm kind of curious how much I actually spend I average about 35 miles per gallon. Let's do it real quick here, guys. I'm just curious. I drive about maybe 9,000 miles a year divided by 35. It's 257 times $3.50 just to make it. I spend about $900 in gas, and I do about one oil change, so maybe 2 oil changes in that time frame for 2 total. The oil changes and all that stuff. It's so cheap, guys. I can't justify buying anything else, especially with a car that gets that good of mileage. So how do someone become a millionaire, right? These are the things that you have to do. You basically keep all the money in your pocket and you protect it from leaving your accounts. You keep it inside your pockets. That's how you become a millionaire. And you look at everything in your life. You look at everything where you're spending and say, how can I cut it? How can I cut it? How can I cut it? And then you take that money and you just go and invest it. And what can get really crazy is if you start dividend investing and you get dividends, right? So you get dividends, you get, I don't know, I'm just going to make up some number and people will say, oh, it's easy for me. I started with nothing, guys. I was you in my 20s. I didn't have that much and I didn't, it's not like I inherited a bunch of money or anything. So what I did is I just started building, build. I had physical metals, I'm building that. I've got dividend paying stocks, I'm building that. I've got some speculative positions, building that. All of a sudden, you're getting $1,000 a month in your dividend income. Now it's $2,000, then it's $3,000. It starts building. All of a sudden, you've got $5,000 or $10,000 a month in dividend income. Perfect. Still be cheap on the, still be frugal, so to speak, on what you need to be frugal on. And then look at your life too. Look at your life and say, do I really need this? Is it really going to make me happier? And is it going to improve my standard of living? If the answer is no, more than likely it's probably something that you don't need. But maybe I'm just built different. I don't know. I actually see a lot of stuff in my life that I don't want. I like empty rooms. I don't know why. I just do. It feels like the psychology of my brain is freer. It's emptier. So I like it when things are, simple. It's not a minimalist lifestyle. It's just when you don't have things cluttered around you, it's easier to think. And I know it just seems, I don't know, just easier. It's easier for me, at least. And not every room's like this, where I don't have the furniture and stuff like that. But I just nitpick everything when I was growing up. I'm an engineer by trade. Got to keep that in mind too. My entire degree was how to make things more efficient. And you want to cut the costs. Is coffee worth it? Is drinking your calories, is that nutritious? No. Get it out of my thing. I don't need anything that I'm drinking that isn't healthy and nutritious. So it's just, I just drink water, guys. I drink nothing but water. That's it. And how expensive is water? It's basically free. And you're supposed to hydrate yourself. Pop doesn't hydrate you. Water does. Most things that you drink that are sugar or alcohol related dehydrate you. And I'm not a big caffeine person. I know somebody asked me about caffeine. I don't like caffeine. Keeps me up at night. It messes with my sleep cycle. I don't need it. I don't need it. It's not from a cost perspective. I just don't need it. So when people start looking at things, I know some people commented on me fixing things. Oh, your parents showed you that. Guys, parents didn't show me anything when it comes to fixing things. I basically can fix anything. That's the mentality I have. When I was in high school, I would rip things apart, put it back together. My mountain bike, I had one diagram on a Honda CR 125 of a front fork, and it had an exploded view of that front fork and the seals and all that stuff. I took the front forks off. I took it all apart. I got it. I brought it to a place to change the seals because they were leaking oil through the seals. And you need a special tool for that. And then I put it all back together. I had one picture of it. No one showed me how to do it. There was no YouTube at that time, nothing. It's just me. So when I started looking at some of these things, and some people did show me some things on, we'll say, some more complicated teardowns of cars and stuff like that, I just hung around and looked and watched. So now I can basically probably do a rebuild of a rotary engine by myself. And I bet you I could do it better than the majority of people because I know the engineering background as well. A lot of people say they want to build a tight engine. A problem with the tight engine is when things start to heat up, they expand. So you need to have certain tolerances in certain areas between the corner seal and your side seals. Otherwise, it'll bind up, push the corner seal out, and destroy your rotor. You know, the not the housings, the plates. So yeah, there's a lot there that that you just figure out. I mean, I just changed a garbage disposal and swapped over the power cord. You know, some people don't even know how to do that. I'm interested. Are you guys interested in learning that stuff? I can create more videos and show you guys how to do all this. It's not that hard. I can do it. I also have to change a wheel bearing on a car that's out there. It's got a bad driver's side wheel bearing. So I'm going to push the hub, get a hub, push the bearing into not. You've got the hub, you've got the bearing, and then you've got your whatever it's called that goes into it that connects to the car. You push the bearing in, you put the hub in, push it all in, and it's all good. It's not that hard. Do that with a press. But I could show you guys all this stuff. I could create another channel called The Oldest Millennial. Show you guys how to fix all this stuff. Show you how to take off a. I just cleaned out some crap out of the gutters. I changed a handle on a toilet. I cleaned out every once in a while. You get those like where the handle comes to the flusher, and then the water comes back up and refills the bowl in the back. You have to take those things off. You twist it, take it off, and there's crap in there sometimes. So you have to clean it out, put it back in. You're good to go again. But if you guys are interested in that, I can create another channel, go through all that stuff. I can even show people how to tune cars using a Power FC and a rotary on an RX-7. It's a 20 by 20 grid. You've got RPM and load from your map sensor. And I can show everybody how to do all that stuff. And this is stuff that I figured out reading manuals from that perspective and trying it myself. I can even show you how to street tune cars. I can do all that stuff. But yeah, I've got a pretty big interest in fixing things and avoiding costs. And that's really helped me because I fix everything. You know, a window regulator breaks and your window breaks and it goes down. I fix it myself. So that's what I've got for today, guys. Hopefully you enjoyed the content. Give me a thumbs up for the content, subscribe to the channel, and we'll catch you guys next time. This is Finding Value.